Welcome to vTalkInsight, Allocator's Lens Daily for March 23, 2026. Cross-asset pricing is being driven by a powerful mix of a Gulf energy shock, rapidly repricing front-end yields, and equity markets that are only slowly adjusting to stagflation risk. Let's start with equities, where the tension between elevated valuations and rising macro stress is becoming harder to ignore. Equities are now clearly trading under the shadow of higher energy prices and rising yields, and that mix is pressuring the traditional growth leadership. The S&P 500 is heading for a fourth weekly decline. Volatility is pushed back into the mid-20s, and the index is at risk of holding below its 200-day moving average for the first time in almost a year. Flows back this up, with roughly $64 billion reportedly pulled from major U.S. equity funds over 3 months, and active managers cutting a large share of risk, while major derivative expiry and index rebalancing event is adding to intraday noise. Under the surface, the picture looks more fragile than the headline indices suggest. Market breadth has been poor, with close to 400 S&P names declining against just over 100 gainers on recent sessions, and even traditionally defensive sectors like healthcare and consumer staples have been falling in line with cyclicals instead of offering their usual cushion. Key leaders such as Amazon, Nvidia, and large banks like JP Morgan have triggered long-term momentum sell signals, and a broad pullback across the so-called mega-cap technology complex has dragged the main U.S. benchmarks lower. That is happening against a backdrop where aggregate S&P valuations sit far above levels seen in earlier oil shocks, leaving limited room for earnings disappointments if energy-driven costs keep rising. At the same time, there is a visible rotation in who is carrying equity performance. Energy stocks have surged more than 30% year-to-date and remain relative outperformers as oil prices spike, although their day-to-day returns are volatile and closely tied to Middle East headlines. European and Asian markets, which are more exposed to imported energy, have suffered deeper drawdowns than U.S. large caps, with European airlines squeezed by fuel costs and luxury names hit by rate sensitivity and Middle East uncertainty. By contrast, emerging market equities excluding China have outpaced developed markets by over 20% over the past year, helped by strong technology segments, and there is still notable investor interest in AI and chip-related stories globally, even after recent profit-taking. Sentiment indicators now point to growing stress, but not full capitulation. Client surveys show risk appetite at its weakest in over a year, and many investors more focused on avoiding losses. Yet overall positioning remains broadly risk-on, and short bets among macro funds are extremely crowded, raising the prospect of sharp squeezes on any positive catalyst. Some equity strategists still hold relatively constructive medium-term index targets, arguing that modest valuation expansion and resilient earnings could offset geopolitical noise. The key tension for allocators is whether today's energy shock tips the backdrop towards stagflation, which would challenge both high growth and defensive sectors, or whether AI-led investment and solid demand can keep earnings growth intact. That question links directly into what is now unfolding in rates. Rates markets have moved decisively to price a higher inflation path, and the greatest stress is at the front end. Short-dated yields in the United Kingdom have risen close to 100 basis points since the conflict escalated, with the 10-year gilt now around levels last seen in the global financial crisis era. Germany and the United States have also seen meaningful moves, with front-end yields up and curves flattening as investors respond to the combination of oil above $100 and renewed inflation worries. The result has been a painful period where both equities and bonds are selling off together again, echoing the positive stock-bond correlation that made diversification so difficult in 2022. Policy expectations have swung sharply in response. Markets now anticipate multiple rate hikes from the European Central Bank and the Bank of England this year, a complete reversal from the easing narrative that prevailed only weeks ago, as officials stress the need to contain energy-driven inflation. In the United States, earlier expectations for near-term rate cuts have largely evaporated, and some participants even discuss the possibility of further hikes if inflation stays elevated, though Federal Reserve voices remain more balanced. Fed officials still pencil in rate cuts over the longer horizon, and at least one policymaker has signaled openness to easing later this year if the labor market softens and oil pressures do not intensify further, illustrating the more data-dependent stance in Washington compared with Frankfurt or London. From an allocator perspective, the question is whether this rate's repricing has already gone too far in some regions. Commentary suggests that if the conflict were to escalate faster than currently feared, front-end pricing for the ECB and Bank of England in particular could unwind quickly, creating significant mark-to-market risk for those leaning too heavily into the latest hawkish narrative. U.S. real yields are seen as relatively attractive versus global peers, helped by the country's lower oil intensity and energy independence, which also supports the dollar. At the same time, some emerging market local curves, including in Brazil, South Africa, and parts of Central Europe, are starting to offer more appealing long-end yields after the recent global sell-off. But the pace of headline-driven moves keeps duration risk firmly in focus as we turn to credit. Credit markets look relatively orderly on the surface, even as the macro backdrop becomes more challenging. High-yield spreads have widened somewhat in recent risk-off days, but they remain below levels that many managers cite as attractive re-entry points. And the overall quality of the high-yield universe has improved, with sizable exposure to energy producers that are currently enjoying stronger cash flows. Investment-grade corporate bonds continue to attract demand from investors looking for known income and moderate spread compensation over government curves, despite elevated new issuance and some drift wider in risk premia. Beneath that calm, several fault lines are visible. Persistent oil strength, especially in benchmarks linked to the Gulf, could eventually force a broader widening in both high-yield and investment-grade spreads as input costs start to squeeze corporate earnings. Concerns are particularly acute around European investment-grade bank paper, where spreads remain tight even though a prolonged energy shock could significantly erode profitability and raise asset quality questions, suggesting scope for repricing. In emerging markets, high and rising energy and fertilizer costs are stretching fiscal positions in countries that rely on subsidies, yet sovereign bond yields in some African issuers have only moved modestly, indicating that a full deterioration scenario is not yet reflected in prices. The more acute stress today lies in private credit rather than in traded bonds. Large semi-liquid funds are seeing record redemption requests, with some managers turning to collateralized loan obligation structures to manage outflows, and worries are mounting about the combination of lax underwriting standards and concentrated exposure to cyclical sectors such as software. Questions around valuation transparency and limited exit routes mean that any further deterioration in the macro backdrop could amplify volatility in this corner of the market, even if listed high yield remains comparatively insulated for now. For multi-asset allocators, that reinforces the need to monitor liquidity and cross-exposures between private vehicles and the banking system, rather than relying solely on headline spread indices. Foreign exchange markets are being pulled by the same forces reshaping rates and commodities, with the U.S. dollar back in the spotlight. Speculative accounts have flipped to a net long stance on the dollar for the first time this year, reflecting both the repricing toward higher U.S. yields and renewed safe haven demand as geopolitical tensions intensify. America's relative insulation from the worst of the energy shock, thanks to its exporter status and lower oil intensity, is also helping explain why U.S. fixed income has outperformed many global peers and why the dollar has been a key driver of recent FX moves. In contrast, emerging market currencies that rely heavily on imported energy, particularly in Asia, have lagged as higher oil costs and stagflation fears weigh on their outlook. There is, however, significant differentiation across emerging markets. Latin American exporters, such as Brazil, and balanced producers like Mexico, are seen as relatively better placed, with higher commodity revenues and, in Mexico's case, consumer subsidies that help cushion domestic pressures. Some commodity importing countries with solid reserve buffers and credible policy frameworks, including those that hold meaningful gold reserves, have also weathered recent volatility better than in past crises, underlining how external vulnerability has improved over the last decade. For allocators, that means the energy mix and policy credibility are once again central to FX risk management rather than a simple developed versus emerging market divide. Alongside traditional FX, structural change is accelerating in digital currency and payment rails. Stablecoin transaction volumes have reached into the tens of trillions of dollars annually, supported by the rise of AI-driven, always-on financial activity that values instant, global settlement. Major incumbents are moving in, with large card networks acquiring stablecoin infrastructure providers and regulators in the United States, making progress on clarifying when digital tokens count as securities or commodities. At the same time, exchanges and brokers are winning approval to tokenize conventional securities, hinting at a future where parts of the FX and payments ecosystem run increasingly on blockchain-based infrastructure, even as the dollar remains the anchor for now. Commodities, and energy in particular, remain the fulcrum of the entire cross-asset story. The effective closure of key Gulf shipping routes and repeated strikes on infrastructure have removed a substantial share of Persian Gulf exports from the seaborne market, with estimates pointing to an unprecedented drop in flows. Qatar's liquefied natural gas capacity has reportedly been cut by around 17% for several years, equating to roughly 3 to 4% of global LNG supply, while refinery shutdowns and gas field outages in the region have taken millions of barrels a day of crude and refined products offline. Physical crude prices in hubs like Oman and Dubai have surged far above longer-dated contract levels, underscoring how immediate supply stress is, even before considering longer-term damage. Price signals across the complex are flashing stagflation risk. Spot oil benchmarks have rallied sharply, with crude in parts of the Middle East trading at historically high levels and Brent up around 50% over the month, while the spread between seaborne benchmarks and U.S. inland grades has widened markedly. Global oil markets have fragmented into distinct regional price zones, with some Asian buyers reportedly paying vastly more for barrels than counterparts in Europe or North America. On the product side, an extreme diesel crack spread on the U.S. Gulf Coast, near $70 a barrel, suggests that either crude prices need to move even higher to balance margins, or refined product prices will eventually fall back via demand destruction and a broader economic slowdown. The second-order effects of this energy shock are spreading well beyond oil itself. Fertilizer shipments that rely on the same shipping lanes are at risk, with some estimates pointing to food price increases of several percent that would add another layer to the stagflation story and complicate central bank policy, especially in more fragile economies. African nations are already facing acute refined fuel shortages and are turning to new suppliers with limited capacity, while some are increasing coal use despite climate concerns as they struggle to secure affordable energy. By contrast, exporters like Russia and several African and Latin American producers are positioned to benefit from higher prices and diverted trade flows, and the United States remains relatively insulated, reinforcing its macro resilience. Gold, interestingly, has not delivered the classic safe haven response to this turmoil. The metal is on track for its worst weekly performance in years as expectations for higher for longer interest rates raise the opportunity cost of holding non-yielding assets. Even though surveys still place gold among the top asset allocation choices, and emerging market central banks have been buying on dips. Beyond precious metals, elevated energy prices are increasingly cited as a constraint on the global AI investment boom, given how power-intensive modern compute infrastructure is, and this is already influencing where new data and advanced manufacturing centers are being built. For allocators, the durability of this energy shock, rather than just today's spot price, is what will ultimately determine whether the coming quarters look more like a manageable slowdown or drift toward a harder landing. Stepping back, the cross-asset message is that a severe and potentially long-lasting energy shock is forcing a rapid repricing in rates and complicating the equity and credit outlook. Equities are adjusting through weaker breadth, pressure on former leaders, and a powerful rotation toward energy and selected emerging markets, while valuations still leave limited room for error. Rates markets have swung hard toward higher for longer, especially in Europe and the United Kingdom, raising the risk of future policy reversals if growth falters. Credit remains broadly orderly, but private credit and some bank and emerging market exposures show that liquidity and tail risks are building beneath the surface, even as the dollar and commodity exporters benefit in FX. Commodities are the hinge, the length and depth of the Gulf supply disruption, and how central banks choose to respond will be key for whether we end up in a softer landing or a more stagflationary environment. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.